Welcome, ladies and gentlemen, to our 34th COVID webinar. Wait a minute. We've actually rebranded it to the Housing Market Update based on many of your questions. And also, hopefully because COVID becomes less of a point in our considerations in our industry. Oh boy, and considering there are all sorts of different changes happening in our industry, we're going to talk about it today. It's been a roller coaster ride since we saw you all last, and boy, oh boy, we're going to do our best to decode some of the things that are happening and also interpret them. And know that before we begin, we will have a recording of this that you can share with your team. And we always welcome any questions that you can put forward. So if you've got them, send them through and we'll do our best to address them now or later. And Allie and I certainly use that as a driver for future concepts and ideas. We are extremely proud to announce that we have launched 3 really cool data products. And the first is Building Product Pro. This is for the building product manufacturing side of the world. Enterprise, of course, is the complete data solution for home builders. We've got Mortgage Pro for the mortgage industry. We're tracking the life cycle of housing. And these all have new version releases. So it's great data. It's complete. It's actionable. It's customizable. And speaking of customizable, that's where Allie and I come in. And our advisory team is a team of 60 people across the country. We're supported by Allie and the economics team, unbelievably smart people. And these researchers, the 500 researchers that you see, they're involved in all of our enterprise solutions. And of course, I want to call out our award-winning builder editorial team, particularly Jen Lash and Jennifer Pierce, who are so great to work with. And I think many of you know them. Now, today's agenda, there's 8 things we're going to go through. The first 3 Allie will address. I'll get the final 5. And allow me to give you the introduction of Allie, which if you've tuned in before, you've heard me talk about her background and the skill set she has, but primarily you need to know she is our chief economist. And with that, she's adding perspective, and some of the concepts today she'll talk about is what's happening to price and pivots that are going on in the market, the buffers that we have, and we'll see how they hold up, what happens with inventory and confidence, which is shifting so rapidly. And she's helping much of our strategic analysis on the advisory team. But I think the single most important thing to bring to you about what she's been toiling over is the monthly meeting of the White House Council of Economic Advisors. And she's part of that. She's meeting with them monthly, and she brings back perspective that sometimes alarms me. And it won't surprise you probably, but the government will look at what's happening in the housing market and say, oh, good, it's slowing down, prices are down, affordability is going to improve. While that might be a true statement, there are ripple effects in the industry and in the economy that are coming from that. Allie and the council are doing their best to educate the government about that, to educate the president and his team about that, and know that today we'll talk about some of those themes that Allie's been sharing. So with that, Allie, my friend, would you please step up in the virtual stage and take it away.
Awesome. Thank you, Tim. And yes, when we look at housing from our industry, from a policy point of view, we know that, and my whole first section is going to be why there is a little bit of hope that housing does slow. And indeed, we have seen that. And that's because while there's a ripple effect to housing slowing, there's also a ripple effect of housing being too strong and how that can impact the overall economy itself. So we're really in this ecosystem where all of these different players go together. And sometimes the slowing part of one economy is good for the wider good. And we'll talk about why that's the case, why we're trying to track all of these different sectors and why all of them are so important to see how they interrelate. So as I dive in, we're going to start with the economy. And of course, we're meeting here on Fed Day. So happy Fed Wednesday. The expectation, I've been on this call since 11. So in case I missed anything, the expectation is that the Federal Reserve raises rates another 75 basis points today. This was extremely well communicated. This is what we expected to happen. And of course, the reason we're seeing a policy change is in response to a lot of things that are happening in the broader and wider economy. And so we're going to spend the next 5 to 10 minutes talking about the background in the economy, the basics, what's happening, how you should be interpreting information, especially when tomorrow we get a massive report on the economy. So let's step back. why are we seeing changes in the market? And why is the Federal Reserve changing policy? And all of this ties back to inflation. The fact that inflation right now is at the highest level it's been in 40 years. We continue to see it spread across multiple sectors. As a reminder, inflation, I'm sure you all feel it on the ground, so I don't need to tell you, but it's a general increase in price and a resulting drop in purchasing power. And that purchasing power is falling to some segments of the economy more so than others, some individuals on a fixed income or some lower income individuals. It is one of the two of the Federal Reserve's dual mandates to get this under control. That's why we are seeing the policy change. Now, when we look at inflation, the big question is, remember, in the past, we talked about transitory or not. Now, the big debate is, have we reached peak or not? And there are some signs that suggest maybe we're getting close to peak, which is good. We want to see this overall inflation level coming down. If it's not, we'll be having a different discussion. But right now, as we look at some indicators, there are some signs that maybe we're past that peak level, or if we're not, we'll see that in the next few months. Now, one of the ways we're saying this is if you look at the goods economy was the part that thrived during the pandemic. We were in this price hike. There wasn't enough inventory, and we saw the market really shift up, driving a lot of that inflation. And now we're starting to see some discounts. And those discounts fall in the housing market. You're seeing it in furnishings, electronics, durable goods. Those are items that last more than 3 years. So you're starting to see that those price hikes seem to be, for the most part, behind us. Gas. I don't want to pretend that gas is still not up 40% compared to last year, but when you look at the month over month, down 11%. Same with shipping costs. I think almost about 18 months ago, we were talking about shipping costs and how high those containers have gotten. Container prices are down 65% from the peak, but they're still 5 times more expensive than where we were in those pre-pandemic times. So a few signs that maybe, okay, we're starting to see a little bit of rollover in the economy, which can lead us to, and what you'll start hearing more of, is a disinflationary environment. The disinflation is the change in the rate of inflation. So thinking about going from 9% inflation to 6% inflation, or 6% inflation to 4%. It's that you're still seeing inflation in the economy, but you're starting to see that rate change. As a reminder, right now, depending on the source, we're looking at inflation that is up between 6 and 9% compared to last year, when we should be operating at about 2. So you could see how we could support and want to see this overall inflation level coming down. And as we see some disinflation, when we start to see that happen, that's a result of 2 things. One is the improving supply chain, and 2 is some of the effectiveness of the Federal Reserve policy. So as we see the Fed change their policy, what's happening is they're trying to slow the economy. I think that is such an important key that we need to keep in the back of our mind. Now, try not to confuse disinflation with deflation. Deflation is a general decrease in prices and the resulting increase in purchasing power. So you hear that, and on the surface, it sounds like, okay, that's good. That's what we want. And there are a couple times where deflation can be good. If you have a little bit of deflation and it spurs increased consumer spending, that can reignite a market. If you see deflation in response to productivity gains, a cost has gone down because there's a more efficient way to build it, that's good deflation as well. But you also want to watch out for bad deflation, which would be a decrease in demand. And as the demand goes down, you can see how companies look at their profitability, how companies need to pull back, what they do with layoffs, with wage cuts, how consumers get impacted with their roles, with how much they want to spend their money. You can see how going into deflation can become this vicious cycle. But then there's one other term that you really need to understand, which is stagflation. Stagflation, bad. We don't want it. It's high inflation accompanied by slow economic growth and rising unemployment. Let me put this very simply. Stagflation is a recession plus inflation. People are losing their jobs, and yet costs are still going up. I bring up stagflation, and I wanted to give this kind of high-level view because there are a lot of things happening right now, and I suspect you're going to be hearing of stagflation more and more. And why is that? So remember, recession plus inflation. So let's step back. Let's go back to the last time we met. And I said, hey, first quarter GDP went negative. It did. Here's your data. And the reason it went negative is because we had a change in imports and because we had a buildup in inventory. Now, when you look at that negative GDP read, Let me step back again. GDP, gross domestic product, broadest measure of the economy. When we saw that first quarter contraction in that GDP number, if you ask me, that was not really anything more than a technicality of how GDP is measured, because the components that really matter to the economy, consumer spending, business spending, those were holding up. Now, second quarter, the first estimate of second quarter GDP comes out tomorrow. This is what you need to look for. There is a chart called, in a data set called the GDP Now. This comes from the Atlanta Federal Reserve. They try to take real-time data to estimate where GDP goes. The Atlanta Fed's GDP Now is minus 1.6, meaning they're estimating that second quarter GDP comes out negative. Now, this is an estimate. It could be wrong. We could end up having a blowout report and maybe the number is positive, but using this as one of our guides, we could say, okay, what that's telling us is we then first quarter of GDP that was negative, second quarter of GDP that was estimated negative. And what's going to happen is there are going to be a lot of people that say, haha, a recession is 2 consecutive quarters of negative GDP growth. There we are. We're in a recession. When in fact, economists would tell you that's not the case. So I'm going to keep sticking with some of the technical terms here or kind of the technical definitions, because I think these really matter. There's an organization that calls recessions. It's called the National Bureau of Economic Research. And they have on their website that a recession is a significant decline in economic activity that is spread across the economy that lasts more than a few months. They explicitly have on their FAQ that the financial press says it's 2 consecutive quarters. That hasn't been the case since the 1980s. So as we're looking at this, we're going to be told that we're in a recession, even though I will show you some data sets that say maybe we haven't gotten there just yet. And we're in this very high inflation environment. Recession plus inflation equals stagflation. You're going to start hearing that more and more. And I think this becomes really important in trying to measure consumer confidence, which we know, and it's kind of a theme throughout this deck, has really taken a hit. Now, when you look at the economy and you look at job growth, we're still adding jobs. And there's this belief that, oh, well, everything's fine because job growth hasn't changed. I'd also be careful with that, because what the NBER does is they wait for job growth to peak. And then usually when it turns negative, that's the official day that they call that we are in a recession. We will go into a recession. It'll take them 6 to 12 months to announce it. So there's a lot of factors that are behind this. But what you should look at, and the factors that this organization looks at, is income, employment, consumer spending, and industrial production. These are some of the key categories that they look at, among others, housing, of course, being one of them as well. Now, for us, Nick Skoulas on our team, back in 2018, we were doing the analysis of what are good historical guides, because we realized in 2018, job growth wasn't. It's not really good at predicting a recession. So what is? There's things like a small business hiring survey, housing starts, manufacturing, retail sales, the leading economic indicators, and the 10 and 2 spread. As we look at these, and I look down the list, housing starts have slowed considerably. We know that. ISM, which is manufacturing, is coming down, but it's still in growth territory. I think the same thing applies to retail sales. The same thing applies to small business hiring. Leading economic indicators has gone down. And then, of course, we have the inverted yield curve. So there are a lot of factors that, whether or not you want to say tomorrow we're officially in a recession, we are tracking that a lot of top level economic indicators are starting to shift. And as we look at the 10-year, the inverted yield curve, the reason we bring this up is historically that leads a recession. And each of those gray bars are showing you the past recessions. So we start here, which is there's a really high level of inflation. It's unsustainable. The Federal Reserve is being the most aggressive they've been since the 90s, trying to get this under control. And you know who falls right at the front of it is housing. Housing is an interest rate sensitive industry. So when we say, oh, it's good that the policy is effective, again, that's the point. When you have 40% home price growth, I think every single one of us on this call knew that that was not sustainable and that was not healthy. And so as the interest rates have gone up, we've gotten to this point that the market has slowed. We'll talk in a moment, though, of the idea of have we normalized or have we actually softened or weakened? And I think there are some arguments to be made that we've fallen into that softening and weakening territory in many parts of the country. But as you think about this, I know this is really not going to be an uplifting call because housing has slowed. But remember, for context, we slow quicker than the rest of the economy, because historically when the economy is good, interest rates go up, we slow, and then we can bring the economy down. But on the other side, we also rebound quicker. And Tim and I have a lot of talks about how long might some kind of slowdown last and what might it look like. But what I want to do in this section is go through some of the data that we're tracking that shows how much the market has shifted. Now, we're going to talk national trends. We're going to talk different local and regional trends. We have advisors all across the country that we had a call with yesterday, and we know that not every region and not every price point and not every location is behaving the same, but we have to make some high-level points about what's happening. When I go through this data, and same with as Tim goes through his section, what we need to track is the idea that we have our entire Zonda database, where I will show you data and Tim will show you data from that. But we also supplement that with our division president survey. This is our qualitative information, and we collected this through last Friday. So this is about as current on the July housing market that you can find. And what we found is that 30% of builders said that demand was slower than expected, but not worrisome. So in some cases, is that a normalizing market or a little bit of a seasonal slowdown that you would expect? We have 55% of builders that said demand is slower and causing concern. And as we look at this, we'll provide why some of that concern may be coming to the market. But I wanted to show some of the key indicators in the way that we view it. This is courtesy of Brian Glasshagel, our Senior Vice President of Advisory. He bucketed out some of the bullets to look at for if a market is normalizing, if a market is softening, or if a market is fundamentally weak. And so I took many of these points to show them throughout the rest of this section to say what's happening to sales. What's happening to cancellations? What are we seeing with prices? What about inventory? What about incentives? So let's start here with sales. This is Zonda's new home pending sales index. We released this last week, showing that new home contract sales in June were back to 2019 levels. Now that matches up with what the census put out yesterday. Their data also shows that there was a very significant pullback in overall contract sales. Now, 2019 was a great year for housing. It was really good. We were really seeing a lot of momentum. And so it's okay if we start to see some of the levels that look different, but I also would say we're seeing that the industry has already started to right size a bit. And what do I mean by that? We have some companies that staffed up for 2020 or 2021 levels, and we're looking at the trends. And the mortgage companies were some of the first to pull back because of obviously the change in refinances. But we've also seen some of the big brokerage firms that have had to cut staff to try to match how the market is no longer at that peak in the end of 2020 and early 2021. But this again becomes a very market specific story. The dotted line shows you any market that's about flat with where it was last year to 2019. The markets on the right are above their 2019 sales rate. 2019, again, is our pre-pandemic context, and we have been outperforming 2019 for a really long time. And now we're seeing in some markets like Phoenix, Sacramento, Salt Lake City, Vegas, Denver, Austin, these are markets that are now performing below those 2019 levels. They've really seen a significant downshift in overall demand. And talking to our experts there, people like Stephen Hensley in Phoenix, we are feeling on the ground that the market feels fundamentally different. And these are the markets that had the highest level of home price growth. These were the markets that were borderline the most frothy, that were growing really, really quickly. You could justify it because of migration and because of job growth, but you've also hit a point. Whereas the monthly mortgage payment has gone up at least 40% since the beginning of the year, there are people who have stepped back. On the right-hand side, you have some markets that are just difficult to build in. So the builders that have homes are selling pretty well. But you also have this interesting mix of markets in the Southeast. And what I wanted to layer in is the markets in the Southeast match a lot of the analysis I said for Phoenix, Sacramento, Salt Lake. A lot of people moving in, really rapid home price growth, inventory that is still tight and pushing up prices. And what I think one of the things that we're looking at closely here is a lot of those markets that are still outperforming 2019 levels are still areas that are investor hotbeds. When we look at investors, overall investor activity has slowed a bit in response to the higher rates and the higher housing costs. But in talking to one of our experts, Christine Smale, she is our senior vice president and one of our Southeast experts. She said, really, if you look at the fundamentals for investors, the Southeast still makes sense because you have the migration numbers, you have the household formations. And I think there's a lot of bets that are still being made on, if you're looking at the market, the Southeast has some of those standout factors. And I think some of the investor activity is supporting those overall sales levels. But let's go back. So we're saying sales back to 2019 levels. What are we seeing with cancellations? Well, I'm sure a lot of you have seen plenty of articles about cancellations recently. That has been really the media's favorite thing to cover. And when Tim and I were meeting, we had seen that April felt like the inflection point. And we had said, okay, we think this is when the market has started to turn. And that was because we started to see an increase in cancellations. And those trends have carried on. As we look at June and July, we have a fairly high percent of builders that reported an increase in cancellations month over month. Some builders saying that the overall level was flat. Now, why would we be seeing cancellations? I think there are three main reasons. One is, as Tim will show, inventory is still constrained, but there are more resale options in some markets. There is a little bit more for sale, new product that's out there. So people have a little bit more options. Maybe that's playing into the decision. A lot of it is the qualification issues and how much the payment has changed and how quickly. And then some of this comes down to confidence. There's just uncertainty about what is going to happen. And a lot of people have chosen to sit on the sidelines. When we look at cancellations, this varies wildly by market. We have some markets where the cancellation rate is above where it was when the pandemic first hit. Those are markets that we're really seeing some severe weakening. There are other markets that the cancellation rate's a little bit higher than normal, but it's not that alarming. This becomes, again, a very localized story. But as we look at this data, my biggest follow-up question is, can you resell the homes? 50% of builders a few months ago said, yep, absolutely, easily. Today, it's 13% of builders that can say they can easily resell the home. 40% say for the most part, and about 50% say no. No, they can't easily resell the home, at least maybe not without putting some incentives towards it. 73% of builders reported increasing incentives month over month. And in our database, we can look at the incentives by market, by dollar amount, by share of overall projects. And still a lot of them are closing costs with the preferred lender, but starting to see some of the incentives creep out into some other categories as well. And as we look at this, one of the questions we get is, well, what incentives are most effective? And the answer is, it really depends. We had some builders that said traffic is so low, the demand has really fallen off a cliff. There's no amount of incentive that's helping. There were enough builders in our survey that said that I felt it was worth mentioning. But there were a lot of builders that also said, well, it was rate buy downs that was effective, or a rate lock, or money towards the closing cost, money towards options. And I think most specifically, giving the sales managers the flexibility to address each of the buyer's hot buttons, whether it is lowering the price of the home, whether it is a little bit towards options and upgrades. But as we look at this, we know that sales are down, cancellations are up, incentives are up, and prices for the most part are holding flat. 70% of the builders we talked to took no price increase. We did, though, have 20% of builders that dropped prices. And they dropped prices for a variety of reasons. Sometimes they dropped prices because demand was just slow. It's just trying to drum up interest. Sometimes it's because their competitor did. So they're trying to keep pace. And sometimes it's because of a buildup in inventory that we'll talk about in a moment. Now, we know that lowering base prices become a big headache for the market and become a big headache for the backlog, but we also can see in the data why some builders would be considering it. So here what you're looking at is Zonda's quick move-in data, also known as QMI, standing inventory, speculative inventory. We've seen that QMI has increased pretty rapidly after 2 years of basically not having any. These are homes that could be moved in within 90 days. This level is not alarming. This level, as you can see, is back to where we were in 2019. That feels a little bit like a theme of today's presentation. But as we look at this data, obviously, one, this feels a lot different. Two, this is changing every day. We can update this data daily. We update it weekly. We're trying to track, does it level off here or do we see it go higher? But it's also the existence of quick move-in in certain markets that is supporting trying to move those homes quickly, trying to offload them, and in some cases, coming with those price cuts. So here, when you look from Jacksonville down to Phoenix, these are markets that were flat to above the quick move-ins that we saw in 2019. As you go further down the list, you can still see, for the most part, QMI not back to 2019 levels, but we've seen a pretty rapid increase as just the overall demand story has changed. When we look at the market and we really roll all of this together, whether or not the builders have QMI, whether or not they shifted their strategy, generally speaking, we're seeing that demand has slowed. And in response, we have 87% of builders that we talk to that plan to slow starts. And that's just in response to the changes in the market. Things like we cannot start more homes with weak sales, or we're cutting starts at least 50% for 2 months. This pause will allow us to assess the market. That sounds very similar to what I said with consumers, where a lot of people are just saying, how does this play out? Let's just sit back and see how the market ultimately progresses. Which takes me to my final section, which is, I'm sure a lot of you are struggling with how to forecast from here. Frankly, we are too. There are a lot of moving parts. And we meet every month, Jonathan Dienhart, Nick Skoulas, John Mazzaros, myself, Drew. We're talking through all of these different things. We have a model that's telling us where the market might be, and then we're adjusting that based on what we're seeing. But one of the things that I said to you on our last webinar was rising interest rates in isolation are not always that painful in terms of a slowing of consumer demand until it's rising interest rates plus bad headlines. And 2 months ago, we weren't really seeing bad headlines. There was still a lot of support to the housing market, and that has absolutely changed. When you look at some of the headlines, you see things like, it looks a lot like a housing bubble. Keep an eye on these overvalued housing markets as the housing boom implodes. Economist who called 2008 housing bubble warns of home price declines. These are alarming. Bubble, 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 2008. Lots of scars that are coming out, both from our industry and for people that are reading them. And I think what's important is to remember, if you're reading those and thinking about 2008 and you're thinking about all the pain that happened then, think about what's changed. Think about the Dodd-Frank laws that went in place where mortgage credit availability has changed considerably. This is an index that comes out from the Mortgage Bankers Association, and 1,000 is the most loose credit could ever be. Last cycle, we were at 900. Today, we're at 120. We know the people that bought, there is hard data on it. They had good credit scores. They had good debt to income ratios. There was skin in the game. That's a very different change to the market. Lending standards, day and night. Last cycle, 26% of all loans that originated had a credit score under 660. Today, it's 6%. Last cycle, 24% of all loans had a credit score of 760 plus. Today, it's 70%. These are very, very different numbers. So I get that the run-up in home prices can draw that parallel to last cycle, but we also need to rationalize and keep things in the back of our mind of there are similarities. Of course, there are similarities, but there are also some differences, and the differences are pretty impactful. I don't want to pretend there's not going to be pain. And I'm sure some of you are on the call and haven't sold homes in a few weeks. We're hearing that fairly regularly now. And so we want to acknowledge that, of course, the market's shifting. And even with these sound fundamentals, if enough consumers pull back, the market has slowed. And we know that that has already happened. So for us, as we're thinking through the market, we wanted to look at what could happen with prices, what has happened with prices historically. And this is looking at new home prices, the change during these different recessions. And you can see, of course, that the great financial crisis was the biggest drop. And when you're looking at that, the reason it's not more dramatic is what you're probably thinking is a lot of the really traditional boom bust markets that saw those 40 to 50% drop. When you look at the overall national average, about a 20% drop. And other markets, we're talking a 3% drop, a 7% drop, a 10% drop. But to me, the important follow-up is, well, how long? If prices went down, how long did they stay there? If you look at the different cycles, you look at the months it took us to get to the bottom. If you remove out the great financial crisis, just saying, we can look at it, we'll absolutely look at it, but we also want to say, what would a normal, if you do have a normal recession, look like? If you include the great financial crisis, it takes about 12 months to bottom. If you exclude it, this is an average. If you exclude it, it takes you 6 months. And then the months to exceed the previous peak. You can see how that looks by different cycle. It will just depend. But on average, we're looking a little over a year. So let's say we follow history. Like we said, we already know 20% of builders have cut prices. We know that resale sellers are having to cut their prices, though that doesn't necessarily mean people are falling backwards in price just yet. It depends on where they set the price and how much they dropped it and what the other homes in the market sold for. But let's say we follow history and those price drops happen on a more broad basis. Let's provide a little bit of context. In March 2007, if you were looking at that, that was the peak for new home pricing. If you were looking at that and there was a 10% drop in prices, that brought you back a half a year. So the prices from March 2007 then became September 2006. When you had a 20% drop in prices last cycle, that brought you back 3 years. When you had a 30% drop, that brought you back 4 years. You think about how many people bought homes over those 3 and 4 year periods, and you can see why a 30% drop in prices impacted a lot of people. And then as you go further out, we're talking 7.5, 8, 9 years when you go to 40 and 50% drop. When you look at where we are today, obviously we had a very rapid run up in prices. When we look at a 10% drop from where we are today, that takes us back a year. If you look at a 20% drop, that takes us back 1.5 years, 1.5 years versus 3 years. Let's just say if there was a 30% drop, that brings you back 2 years instead of 4 years. The existence of the equity and how long we've had the buildup in equity and how quick the run up in prices is offers this really interesting buffer. Another way to say a 20% drop in home prices last cycle caused a lot more damage than a hypothetical 20% drop would this time. Not only because of duration, but also because of who bought and what kind of fundamentals were behind those buyers. You can look at this by different markets, just looking at the historical context of what a 10% drop would do in terms of where would it bring you back. 20% drop, 30, 40, 50. For us, as we're forecasting, we're always doing the what ifs. What if it's a 10%? What if it's a 30%? How does that play in? How will the consumer mindset change as we see these different levels? And you can see that there's a lot more room to weather a little bit of a price drop. I think we've pretty clearly been on the camp that we don't think prices just go up forever. We do think that an adjustment is something that is reasonable. But we also know, and we showed last time in this webinar, our millennial research and our interested buyers, the pool of people that still would love to own a home is so strong. It's unwavering. The home ownership is still such an important part of building wealth, such an important part of the American dream, but we've run into the speed bumps. And the speed bumps really tie us back to the beginning of the presentation, which is what's happening with the Federal Reserve, what's trying to happen to slow the housing market, and how slowing the housing market can get inflation in check. And then maybe we can see a little bit more sustained growth. Obviously, a soft landing is a lot more difficult to pull off than a hard. But what we need to watch is how the market progresses. I think this is one of the big things that we're asking ourselves, which is the Federal Reserve is raising short-term interest rates. As they do it, investors are perceiving that the risk of a recession has increased. With that being the case, you know what's happening? The 10-year yield is coming down. When the 10-year yield comes down, generally the 30-year fixed rate mortgage comes down as well. We've seen that the 10-year is back to 2.8. Looking at some historical context, that could put the rate at 4.5 to 5%. And I think a big question is how much of the rate hike, not just this hike, but future hikes are baked in to the 10-year. And that can put a lid on where mortgage rates go. Now, if inflation doesn't come down from peak, like we started the presentation on, if we see the market just really get unruly and it's not responding to a lot of the policy signals, that becomes a different story and a different discussion. But I think what we watch is how do consumers respond? Confidence in housing, confidence in the economy, battered. It's really not looking good. But we also know that there's not as much competition. You can get some rate buy downs. There's some price cuts. There's some incentives. There's some reasons why people would still consider to come into the market, but we're not denying that obviously we're going through a very tough part for the housing market as we stand today. So with that, I'd like to turn things over to Tim Sullivan, our Senior Managing Principal of Advisory. Many of you know Tim. He oversees our entire custom market study business, including the single family built to rent space, master plan community analysis, and basic feasibility studies. Now, Tim often says the economics department here at Zonda focuses on the so what. And one thing that I've realized about Tim and the focus of our advisory group is the thought, then what? Tim is always challenging us to think a few steps forward. If this happens, what happens there? What does this mean for housing? What does this mean for the economy? What does this mean for a certain site in a certain project? And he's challenging us regularly, and we're all better for it. So Tim, let me pass it off to you.
Ali, thank you so much. And that introduction is a perfect segue to kind of a rephrasing of something you said, and I want to formulate a question from it. And it's kind of along the lines of now what? Because we have so many of our friends and clients in the industry that are asking, how bad will it get? And I think you laid out some really important things. We don't know for sure, but we can look back at history, at least as some of the possible what ifs. And that months to bottom number you had, I found that fascinating. That was 11 months average during the last 7 recessions, but 6-month average dropping down, excluding the Great Recession. And then once we're at bottom, how long does it take us to get to a place where we exceed the previous peak? It was 16 months on average. Without the Great Recession, 14 months. Add context, because we don't know, there's so many outside factors that could influence us. Certainly, the war in Ukraine has been something we didn't see coming. But now, what happens with Taiwan and China? When we think about the what ifs, share with us how you would position where we are right now in previous recessions, maybe some of the buffers we have. You just mentioned a couple. And just right now, everything's going to change. I acknowledge that. But how would you phrase a response to that?
Well, I think one of the important things that you and I have talked about is kind of the quicker the drop, the quicker the rebound, at least in theory. I think one of the stats that this is, again, pre-COVID, I think it was back in 2019, we did a survey of millennials and we said, how do you feel about some kind of upcoming recession? And obviously we had no idea what was going to happen with the pandemic, but there were so many comments that said, I'd love to buy a home. I'm desperate to buy a home. I can't wait for prices to drop to come in. Now, that's a very, I don't want to say naive thought, but that's a thought that you got to assume that you still have your job. You got to assume that there's still confidence. You got to assume that you're still in a place to buy. But I think because of who was able to purchase over the past couple of years, we had these really great, really qualified buyers that had really high down payments that beat out a whole bunch of people that still desperately want to purchase a home, but now a 40% change in the monthly payment has impacted that for them. So I think we have a lot of either regular buyers and investors that are waiting on the sidelines to find that opportunity to come back into the market, which I think could offset a bit of a drop. Again, I think prices will end up coming down. Like we said, we're already seeing that. But I also think on the other end, what we have to think about is last cycle, we were trying to burn through a lot of these homes and a lot of the mothballed communities and all of the lots. Right now, we have a lot of lots in place that in theory, if this is kind of a quick change in the overall market, you can start to see some of the building happen again and you can try to see the demand. I'm not trying to be Pollyanna about it because we haven't had inflation in 40 years like this. Like we have very unprecedented times, very tricky times that we're trying to navigate through. But I think there are reasons to believe that the underlying demand is still there. It's trying to match up that demand with the price and trying to see how that plays out.
I appreciate that. Fundamental demand appears to be there. Price is going to be the key. Is that a fair summary?
That is, and that there's a lot of bumps along the way.
Oh, we're feeling them right now. And in fact, as we jump into a couple of the comments we get from the builder survey, and remember that we reach out to 300 builders, it reflects probably a third of the new homes that are being sold. I don't think this will surprise you, but there's a question, is this 2018 all over again? Remember at the end of 18, we had this pause, and then 2019, as Ali talked about, was a pretty good market. But the other bullet points, I think all of this is something you're seeing, you're experiencing, or your clients are. And perhaps the most important thing is right now, and Ali mentioned it, the inflection point is definitely different by market. And as we ask the question about gross contract sales, and remember, this is before cancellations, I think the key thing is the decrease side. I mean, it's, a third of the builders we've talked to have said that, but note the comments and grab this last one. Even though we've seen July be a little bit better than June, both June and July have had more cancellations than sales. We heard that on a number of occasions, and it gives perspective that the slide continues, but it's happened quickly. And if you heard Doug Bauer, I think it was yesterday, speaking to the media, talking about the whiplash effect and how quickly this has impacted us, it makes sense because this is happening fast and we're responding quickly. Now, when we ask about how builders are dealing with the sales strategy, remember just a couple times ago, we were saying over and over again, capping sales, capping sales, capping sales. Well, not so much now. In fact, more of it's a sales strategy element. It's a process to go through and burn through the specs. And ultimately, whether it's releasing specs or selling harder with specs and giving up a little bit, the builders are certainly focused on existing supply, which is a healthy thing because that's been a quick recognition of how the market has changed. And we're looking every time we talk to the builders about what's impacting the supply chain. And you can see from the graphical standpoint that there's been this erosion over the last couple of years. But every month we're asking that question, and note that there's been slight improvements with the exception of the labor shortages where there's a little uptick, but slight improvements. And Ali made mention that we're hearing and observing that the supply chain is getting repaired. Nowhere near as fast as we would like, but it's certainly happening. And one of the groups in our team that is following the supply chain closely, it's our building product manufacturing team led by Todd Tomalek. And if you look at the inputs and how they're changing, notice a couple of things. First and foremost, just go from the top, lumber getting a little bit better, insulation material, breakers, a little bit worse, but go to the bottom. We still have issues with garage doors, cabinets, appliances, HVAC, and windows and doors. As a side note, if you had an opportunity to hear Todd speak last week on our webinar regarding the home improvement and the BPM side of the world, one of the things that Todd brought up was the fact that the aging stock that we have in so many markets is going to lead to some significant opportunities in home improvement. And we're going to watch that very, very closely as we go forward. So let's explore a couple of the housing trends. And I want to pause on this one because this is an important factor that we are watching closely. And we're looking at units under construction, and we're comparing here the second quarter of 2006, so arguably the last peak, to the second quarter of 2022, arguably the peak that we just hit, and how they're different. But notice that not every market has beaten its peak. And Ali was talking about Austin and San Antonio and Dallas. I mean, these are markets that we had massive in-migration for, massive job growth for, but those numbers are big. And I also want to show you that, keep in mind that population in these markets and job growth has occurred significantly. Since 2006, use Austin as an example, we've had over a 50% increase in the population. That in and of itself drives a whole lot of different housing demand. But let's use Austin as that example. If we look at the trailing 12 months of starts that we had in Austin, and we looked at that 18,000 plus or minus units that are in the pipeline, that represents about an 8.4 month supply. But okay, let's cut that back 25%. Let's just say that we are not going to produce like we did. And I just chose 25% as an example. If we had 25% fewer starts and absorbed into the market, what does that mean? Well, it's a little over 11 month supply. So for those of you who work in Austin, you look at those numbers historically and you tell me how you feel about that. But ultimately, builders are responding with those incentives and the response to get product moved. And as we think down the road about the land strategy, caution is basically the word of the day. The builders and land developers there's deals that are being paused, there's, renegotiation, but caution is the word of the day. And no surprise, because of the previous slide that I showed you with the pipeline that has significant numbers of units in it. Now, let's add some context, because what I'm showing you now are the active listings, 2017 to 2022. And we're seeing listings increase, thank goodness, in most markets. And the reason I say thank goodness is that the resale market outsells the new home sale market. In some markets, 6, 8, 10 to 1. So they're our biggest competition. And when we had this repressed supply, that's where pricing was pushed up so much. So you'll hear the media talk about how fast everything's improving, or I should say exploding in terms of listings, but just make sure to look behind the scenes from percentages to absolute numbers. That's why I showed you the pipeline for the actual new home sales in the pipeline, because let's look at those numbers straight on and have the context about what it means for the market. And speaking of what it means for each of these markets, on the left-hand side, you're going to see Austin and Phoenix and Raleigh. These are markets that have moved relatively quickly, certainly in terms of the year-over-year change. That's what you see in purple. But the gold number is the change from 2019. So look at these markets. I mean, they're still not where they were at 2019. Keep in mind, these are individual markets. And what I had just shown you on the graphic was the national number. But check out these markets. I mean, if you go back 2 years, they're way behind where they were. And that's why we say it's so important in context to look at individual markets. And Redfin had a pretty cool graphic that we're sharing. And keep in mind, these are the metros with percentage, not actual dollar amounts, but percentage of home price cuts. And these are the largest numbers: Reno, Austin, Phoenix. No surprise, but remember also, it's the resale market. So these are the markets where we've seen investors. These are the markets where we've seen growth. And certainly with Reno, Austin, Phoenix, maybe not as much Anchorage, but all of these markets have seen in-migration and job growth. But it's just an interesting quick perspective from the resale side. So affordability has certainly been one of our key points. And read from the bottom, because the biggest worries have to do with affordability: inflation, consumer confidence, affordability, mortgage rates. But move up the line, and as you see, land prices and general economic uncertainty. Whoops, hold on. Let me go back to that for 1 second. And look at the top. What we're starting to see is the concept of how to plan for 2022 and beyond, because that wasn't even mentioned in February. Now, with all of these levers being changed, we have our client base and the home builders saying, okay, what does it mean? What's our new normal? How do we move forward with this? Now, when we ask the question about the most active communities in terms of segment, read left to right: entry level, move up, luxury. But look at the relocation buyers, the relos. And their movement and their increase actually kind of makes sense, because if you think about it, many of them are typically coming from more expensive markets. So the affordability factor impacts them less. But look at the luxury side, they're still moving along pretty well. So all of that gives you a perspective that, the market segments are different and each of the geographies are different. Now, the cash buyer concept is an important one because they really don't care about what interest rates are. They care about the absolute price. They care about buying what they want. Typically, it's going to be a buyer that's got a little bit of means. We've seen that movement of cash buyers inch up since 2020, about 30% to now 35% of the market. But let's also look at the investor share by price tier. And if you pause on this for a second, it'll make sense to you. The top line is the low-priced homes. The medium line is the mid-priced homes. The bottom line are the high-priced homes. So when you think about investors, they're going to be more motivated by affordability, probably a better return on their investment. So we're watching that trend kind of lockstep. And we're continuing to keep our eye on that in each market. And as we focus on the first-time home buyers, they're still out there, and they desperately want to find the opportunity to buy. You heard what Ali said, certainly from the millennial standpoint. There's a burning desire still to buy, but affordability is the key. So we're tracking through the home purchase applications and their desire to grab mortgages, this erosion that we've seen over the last year. But keep in mind that fundamental demand is still there. And as we look at the new home share of contracts by volume, notice something very, very important. And we're presenting this with under $300,000, the $300,000 to $500,000 bucket, and above $500,000. Whoops-a-daisy. The under $300,000 product has fallen off the cliff. And it's fallen off the cliff for many of the reasons that I think most of you know. We've got land availability, labor supply, government regulation, NIMBYism. Basically, the cost to develop is way up. Now, this is a Pollyanna statement, but if we were able to find the way to deliver housing at that lower end, the fundamental demand is there. And if there's a way to do it, and we may be bringing in new technologies, we may be bringing in, more of the offsite construction, that may be one of our solutions. But note, the demand is there. The simple product is the supply is not there. So what are consumers doing about it? They're looking at different loans. They're stretching their budgets. They're paying down debt. But when you think about it, some might say, oh my God, everyone's going to go to an ARM. Well, look at the percentage of ARMs going back to 2006, which is like 35, 36%. And look where we are now. There's actually been a little downward movement, but it's floating around 10%. So ARMs are one of the solutions, but note that it's not like it was last time. And Ali talked about that as one of the buffers, the strength of underwriting. And there's a whole bunch of other things too. The element of buying smaller homes and co-signing, buying down rates. Builders have been really smart about that. But also there's a wait and see element, and rentals come into that. I'll address that in just a second. Now, confidence is a powerful force. We bring that up because When the market's going fine, we really don't talk about confidence. Perhaps we might even talk about a frothy element, but confidence is a positive. Right now, look at the left-hand side of that graphic. The builders are reporting the hesitancy. And it's not just affordability, it's the perception of uncertainty. What is going on in this market? And the more we can do to bring some of the uncertainty out, to bring the process of homeownership to the forefront, that the buy down opportunities are terrific. I think that's something that's going to play into our solutions going forward. Now, we wanted to bring a quick look at the rental market simply because the rental market has been almost the converse of the for sale market these last few months, and we wanted to give you some of the perspective. Now, my associate, Kimberly Byram, who's our multifamily expert, gave us a really great quote. And the quote is, the market today for multifamily can be categorized in 2 words: no availability. That sounds a little bit like the for sale market just a few months ago. But as you think about what's going on in the market, notice that second bullet point. The normal year of rent growth, 3% a year, and we're seeing markets that might be going 3% a month. And that has been lockstep with a lack of affordability in the for sale side of the world. So at some point, we're going to have to pay attention to this affordability in the rental side. But right now, concessions are very limited. The key risk, and Ali mentioned this, and Kimberly will shout this to the high heavens, it's job losses. Because if we see job losses, the multifamily side of the world will see contraction. But right now, not so much. Look at the occupancy rates in many of these markets. And these have been some of the hot for sale markets. And keep in mind, 5% vacancy, so 95% occupancy, is typically looked at as equilibrium. You know, that's fully standardized, and the market feels great, and a property is appropriately set up. Look at these markets. They're almost all above 95%. But look at the rent changes, the 1 year and the 2 year. The 1 year change has been pretty significant, but a 2 year change in Tampa over 40%, or a 2 year change in Phoenix over 40%, that's a difficult one to hold up. So keep your eyes on that purple one, because that's the 2 year change. And there's another element here. You know, the concept of rental or build to rent, the single family side or the cottage style. It's a response to lack of affordability, no down payment, don't have to qualify. And these are important factors that the millennial survey brings out, because right now, why aren't you buying? Well, I can't afford it. I've got student debt, and I like renting because it gives me great flexibility. So which markets are we seeing the build to rent be active in? Of course, Phoenix is the #1 market right now for this. It is absolutely let's call it the laboratory for a build to rent. And keep in mind, it's primarily the horizontal apartment product, but there is single family detached too. And then you can read across and see if your market's there. But notice the percentage change in many of these markets. You know, Dallas, we anticipate to double in the next year. Houston, more than double. Jacksonville, close to that. So there are markets that on a percentage basis are moving pretty quickly. And we're working in most of those markets. I think we've completed over 350 custom market studies for the build to rent market across the country. And it's been in all of these markets. Whew. All right, everybody, take a deep breath, because we're bringing in our final thoughts. We always like to bring in a little bit of good news. And the first element is, you probably heard not too long ago that an untrained passenger was flying in a small plane. The pilot had some type of issue, passed out, and the passenger, who had never flown a plane, actually landed it safely, which blew away pilots who were flying around the area when they landed. And you can see the picture, you know, people are crowded around the plane, but a very logical person who kept their head was able to handle a very stressful situation. Kind of sounds like the housing market right now. Another one, if you are a fan of burritos like I am, there's a tasty tape now that can hold your burrito together and you can actually eat it. I'm not sure I'm thrilled about that one, but I found that it was interesting. I wanted to share it with you because it's a food grade fibrous scaffold and an organic adhesive. Not sure we want to put that in our belly, but this is something we want to put in our belly: coffee. And there's studies all the time. Coffee's good, coffee's bad. Red wine's good, red wine's bad. Chocolate's good, chocolate's bad. I tend to lean towards the fact that I'm going to follow this study because it improves cognitive function. In fact, when we're done here today, I'm going to have my second cup of coffee so that I can get a little bit smarter and help figure out what's going on in the world. Another thing that I love this spin, repurposing landfills as solar farms. So the concept here is instead of a brown field, it's a bright field. I love the concept. And there is a bishop, an Episcopal bishop, that is in Connecticut that is turning guns into plowshares. I think the prophet Isaiah would be inspired by this, but the concept is a beautiful one, trying to keep guns out of the general population and turning them into something that helps us. And the last thing, just a really cool concept. A Dutch company has a zero emissions aqua drone that goes into lakes to try to gather all the pollution, because so much of the pollution that goes to the ocean starts in lakes. And this thing was, of course, created out of a company in Rotterdam. You know how our friends in Europe might lead the process of cleaning up the environment, but another beautiful opportunity. All right, we always leave you with inspiration, and this one is a tough one. It's, as many of you had read and seen, one of the horrific occurrences that happened in Uvalde with a mass shooting, and just horrible, horrible, horrible. And this opens up a whole can of worms for a different discussion. But the thing that I wanted to share with you is that if you're familiar with Bo Jackson, the former football player and baseball player, he read about this. He didn't know anybody in Uvalde. He had never been there before, but he was so moved by it and so concerned about the families that went through this horror. He covered the expenses for all the families. It was hundreds of thousands of dollars. Once again, he didn't know anybody there, but he just stepped up. And in my opinion, we call out Bo. And if you remember the old sayings, Bo knows. Well, in this case, he knows kindness. With that, ladies and gentlemen, we are a wrap for this month's get together. And keep in mind, we are now the housing market update. I see that a number of you have sent questions through. We will address those through follow-ups with you, and also in our next get together. Please reach out to us with any takes on what you'd like us to address. And with that, Allie, I think we can call it a wrap. I want to thank Amanda and thank Valerie for their support in this. And also, if you need help, guys, reach out. We'll do everything we can to help educate you, provide information, and provide strategies going forward. Take care, everybody. Stay safe, stay healthy, and we'll talk to you next time. Thank you. Bye-bye.